So have you ever felt like you're digging for that hidden gem in the stock market, maybe trying to be like those legendary value investors,
Oh, definitely.
but then you find some potential opportunity and it's just so complex it feels like it needs a whole different way of thinking?
Exactly. The usual rules for looking at stable, predictable businesses, they often need a serious tweak. Or maybe they just don't apply at all when you're looking at, well, early stage innovation.
And that's precisely what we're getting into today. We're diving into this really comprehensive independent research report. A listener actually sent it over. It's all about a company called Vivos Inc.
Ticker symbol RDGGL.
RDGL, right.
And our goal here, in this deep dive is really to pull out the key insights from this report. We'll cover the business itself, the management team, the financials, market stuff, risks.
And crucially, what a traditional value investing framework makes of it all.
Right. We want to give you the essential takeaways so you don't have to wade through all the data yourself.
And hey, you can get a prioritized deep dive just like this one. If you become a Euro 4.99 a month member over at stockanalyticsai.com, just give us a ticker you're curious about and we'll put it on the list for analysis.
Yeah, check it out. And the links to the source material we're talking about today, they're down in the description.
You'll definitely want to stick around too, because applying those classic value investing ideas to Vivos, well, this report comes to a very specific, maybe even surprising conclusion. We'll reveal that at the end.
It's an interesting one.
Before we really jump in, though, if you like what you're hearing, please give this deep dive a thumbs up, subscribe wherever you listen. Oh, and make sure you subscribe to the Stock Analytics AI YouTube channel as well.
Good call.
Okay, so first things first, let's understand what Vivos Inc. actually does.
Okay, so Vivos Inc. is a clinical stage company. They operate in the radiation oncology medical device space.
Radiation oncology.
Yeah, their main focus is developing these kind of novel cancer treatments using something called Yttrium-90 or Y90.
Y90. And the technique is brachytherapy.
That's it, brachytherapy.
Which means targeted radiation, yeah. Getting the source right in or next to the tumor.
Exactly.
To maximize impact there and minimize damage to healthy tissue around it.
Precisely. And Vivo's particular innovation here is their platform. They call it Precision Radionuclide Therapy, or PRNT.
That's RNT, okay.
And this platform uses a Y90-based injectable hydrogel.
Hydrogel. Okay, so like a gel you can actually inject
Yep.
directly into a tumor.
That's the core idea, yeah. The tech involves these tiny Y90 microparticles suspended in a hydrogel.
Right.
It's liquid when it's at room temperature, so it's easy to inject. But the clever part is it's designed to solidify, to, gel right inside the tumor mass once it's injected.
Ah, okay. And that gelling in situ, that's the key, right? It keeps the radiation right there, stops it from migrating and hitting healthy stuff. That sounds pretty smart for targeted delivery.
It is, and Y90 itself, it's a beta emitter. That means most of its radiation dose is delivered pretty quickly, within about 10 days. And that characteristic, well, it could potentially allow for treatment on an outpatient basis.
Oh, that's a big deal. Outpatient treatment offers, huge practical benefits for patients. Less disruption.
Definitely.
So based on the report, they have two main product candidates using this hydrogel tech.
Correct. First is radiogel. That's their flagship product candidate for humans.
Radiogel.
It's aimed at solid tumors that can't be surgically removed, non-resectable ones. Initially, they're focusing on head and neck cancers.
Okay.
But there's potential down the line for things like lung or pancreatic cancer. And importantly, radiogel has received breakthrough device designation from the FDA.
Okay, why is that breakthrough designation significant? What does that mean?
Well, it's signaled that the FDA sees potential. Potential for the device to offer a more effective treatment for a life-threatening or, irreversibly debilitating disease compared to what's already out there.
Right.
Now, it doesn't guarantee approval, not at all. But it can potentially speed up the development and the review process, give it a bit of a faster track.
Got it. Expedited review potential. And the report says they're already running human clinical trials for radiogel in India, starting with head and neck cancers.
That's right, yeah. India is the initial focus for human trials. The other key product is Isopet.
Isopet.
Uses the exact same core Y90 hydrogel technology. But this one's designed for solid tumors in animals.
Animals. Interesting.
Specifically things like feline sarcoma, canine soft tissue sarcoma, and even some equine ocular tumors, eye tumors in horses.
And the report highlights Isopet as already being used, showing some growth. It mentions more treatments in clinics in Q1 2025.
Yes, exactly. And this dual market strategy is, well, it's quite interesting. Isopet could potentially bring in some early revenue.
Which they definitely need.
Right. And maybe just as valuable, it could provide real-world operational experience, maybe some useful clinical data points, while the human product, radiogel, goes through its much, much longer, more complex, and frankly, more expensive regulatory journey in the U.S.
Okay, so the mission is clear. Innovative, minimally invasive cancer therapies. What does the report say about how they actually operate, their business model?
Well, right now, it's a lean setup. They're outsourcing pretty much everything, manufacturing, distribution, marketing, especially for regulated markets like the U.S.
Makes sense for their stage.
It does. But the report does mention a strategic plan to eventually set up their own manufacturing facility in India.
Which lines up with where they're doing the radiogel trials.
Exactly. Ties in nicely.
And the industry landscape. The report puts Vivos in some big growing markets, right?
Oh, yeah. Huge markets. Overall oncology, obviously. Brachytherapy itself, the report projects around 7% annual growth.
Okay.
The therapeutic part of radiopharmaceuticals, growing even faster, maybe over 11% CAGR. And even veterinary oncology, that's growing robustly too, around 11% CAGR.
Wow, so the market opportunity, it's definitely substantial.
Absolutely. And the report mentions trends like image-guided therapy, using new isotopes, AI in treatment planning, personalized medicine, all playing into these fields. The potential is there, if.
If they can get over the hurdles.
Precisely. Big if.
And speaking of hurdles, that regulatory landscape in the U.S. FDA, NRC, that sounds like a major one based on the report.
It absolutely is. The path for something new like radiogel involves really rigorous clinical trials. They need to submit standard applications like an NDA or a PMA.
Right.
And they're planning an IDE, that's an investigational device exemption, to even start human studies in the U.S. It's just, it's a long, very expensive, and fundamentally uncertain process.
Even with the breakthrough designation.
It helps. Like we said, it might expedite things. But it's still a very high bar to clear. No guarantees.
So thinking about this through that value investing lens again, understanding this complex business, the science, the regulations, it's step one. And the report seems pretty clear. This is not a simple, easy-to-grasp business like, say, a retail store.
No, not at all. That classic value investing idea of stick to what you understand, it gets really tested here.
Yeah.
I mean, the scientific details, the regulatory nuances, evaluating the odds of success here. It requires expertise most generalist investors just don't have. It's fundamentally different from analyzing, Coca-Cola's market share or something.
It's a totally different ballgame. Okay. Let's shift from the what to the who. Management. Evaluating the leadership is always important, but especially critical for a company like this, right? Pre-revenue, burning cash.
Absolutely crucial. The report specifically highlights two key leaders. The CEO, Dr. Michael K. Karenko, and the independent chairman, Carlton M. Cadwell.
Dr. Karenko's background sounds pretty impressive. DSc from MIT, Oxford postdoc, White House fellow, lots of patents, nuclear experience.
Yeah, deep scientific background. The report does note his age, though, around 79 or 80.
And Mr. Cadwell, the chairman, also experience.
Very. Over 30 years in medical devices, also in his early 80s, according to the report.
So, undeniable experience. But the age of the top leadership, it naturally makes you think about succession planning, right? Even if the report doesn't detail any plans.
It's definitely a factor any long-term investor would have to consider, yeah. Just something to be aware of.
And for a company not making profits yet, capital allocation isn't about reinvesting earnings. It's about managing that cash burn, right? Prioritizing R&D spending wisely.
Exactly. It's all about managing the cash runway. And the report shows R&D spending did increase in Q1 2025. About $119,000 compared to the year before.
Which seems necessary for development.
It is necessary, absolutely. But the results, the payoff from that spending, that's all still pending clinical outcomes down the road.
What about shareholder alignment? Does the report give any clues if management's interests are aligned with other shareholders?
It does point to one positive signal. The CEO, Dr. Karenko, has apparently been buying shares on the open market.
Oh, interesting. Using his own money.
Yeah. The report mentions specific examples, like buying 50,000 shares around 14 cents in October 2024 and another 50,000 around 16 cents in September 2024.
Why is that generally seen as a positive sign, open market buys by the CEO?
Well, it usually signals personal conviction. He's putting his own money on the line at the current market price. It implies he believes the stock is undervalued or has significant upside potential. It directly aligns his financial outcome with other shareholders. Skin in the game.
Right, skin in the game. You mentioned earlier why management quality is so critical here. Can you expand on that? Why so important for this type of company?
Sure. I mean, think about it. You've got limited capital. You're facing huge scientific challenges, regulatory roadblocks, financial pressure.
Yeah.
The quality of the leadership making the big strategic calls, securing the next round of funding, actually executing the plan, it becomes everything. They're navigating incredibly rough waters. Bad decisions or just failing to raise more cash could sink the whole thing, no matter how good the underlying tech might seem.
That makes total sense. The pressure is immense, which leads us right into the financial health section, or maybe the financial reality, based on this report.
Yeah, reality is probably the right word. The report is very upfront. Vivos is pre-commercialization. They have very little revenue right now.
Let's look at those Q1 2025 numbers the report provides. Revenue is tiny, just $26,748.
Right, though the report does note that was up from Q1 2024, and it's likely coming from Isopet, the animal product.
Okay, some growth, but still tiny. But then the report points out the cost of goods sold.
Yeah, this is critical. Cost of goods sold in Q1 2025 was $35,831.
Wait, so the direct cost to deliver their services was more than the revenue they brought in from those services?
Exactly. That resulted in a gross loss of over $9,000 for the quarter.
Wow, negative gross margin.
It's a really significant concern. It means, at the most basic level, the core operation isn't profitable. It costs them more to generate that tiny bit of revenue than the revenue itself.
Okay, that's not good. And operating expenses were up too.
Yeah, significantly. Over $854,000 in Q1 2025. Driven mostly by R&D, like we talked about, but also professional fees, legal, accounting, that sort of thing.
All adding up to a bigger net loss for the quarter, over $834,000.
Correct. And because of all this no earnings, tiny revenue, those standard financial ratios you might look at, price to earnings, price to sales, return on equity.
Useless.
Pretty much. They're either negative or just astronomically high and completely uninformative. The report also notes the book value per share is actually negative.
Negative book value. Okay. So, given that picture, how does the report assess their actual financial stability, their solvency?
Well, the positive is they did have cash. About $3.265 million as of March 31st, 2025.
Okay.
And the report notes this was actually an increase from the end of 2024, which suggests they must have raised some money recently, probably through selling stock.
Right. And minimal formal debt.
Minimal formal debt, yes.
Right.
But the cash burn rate.
Yeah, let's talk about that.
The operating loss was around $863,000 in Q1. That works out to a cash burn from operations of roughly $288,000 per month.
Okay, so with $3.2 million in cash, that gives them maybe a year, a little more runway, just based on that operating burn?
Potentially, yes. But that's without factoring in any big future costs, like major clinical trial expenses, building that potential manufacturing facility, or other scale-up needs.
Right, and that's why the report flags that critical point, management's own disclosure.
Exactly. The disclosure of substantial doubt about the company's ability to continue as a going concern unless they secure more funding.
Going concern, it sounds technical, but it's a standard warning from auditors, isn't it? What does it really mean for you, the listener, as a potential investor?
It means the auditors, and significantly the company's own management, are stating clearly that there's serious uncertainty about whether the company can even stay in business for the next 12 months if they don't raise more money. It's a required disclosure, a big red flag signaling severe financial fragility, and total dependence on finding more cash.
And that cash likely comes from?
Selling more stock, most likely. The report mentions a large number of shares already outstanding, over 453 million as of March 31st.
Which implies a lot of past dilution.
Significant past dilution, yes. And any future financing is almost certain to mean issuing even more shares, diluting existing shareholders further.
So yeah, this financial picture is stark. That negative gross margin, the going concern warning, it really paints a picture of fragility that overshadows everything else.
It absolutely does. It's the immediate overriding challenge.
Okay, let's shift focus a bit. How does the market actually perceive this stock right now? It trades on the OTC markets you mentioned.
Correct, over the counter, which generally means, higher risk compared to major exchanges like the NYSE or NASDAQ. Reporting requirements can be less stringent, and liquidity, the ease of buying and selling shares, is often lower.
And what does the trading data in the report show about how people feel about it? Market sentiment?
Well, as of early May 2025, the share price was hovering around 0.135, 13.5 cents. It's seen a lot of volatility. The report gives a 52-week range that's pretty wide, from about 6 cents up to over 25 cents.
Wow, big swings.
Yeah. The market cap at that price was around $60.5 million.
And the average daily volume? The report said it was relatively high for an OTC stock.
It did, yeah. Between maybe 725,000 and 954,000 shares trading hands on an average day.
Which sounds like a lot.
For an OTC stock, it is notable volume. But as the report suggests, this kind of volume in a low-priced OTC stock often reflects more speculative trading, maybe day trading, rather than big institutions making long-term fundamental investments.
And the stock's beta? High.
Relatively high, yeah. The report cited ranges like 1.0 to 1.37,
Yeah.
meaning it tends to move more, be more volatile than the overall market.
The report also mentions a lack of formal analyst coverage from investment banks. That's pretty normal for these small microcaps, right?
Very typical. It just means there's less independent professional research readily available to the public. Investors really have to rely more on the company's own communications and do their own digging.
And retail investor sentiment. What did the report gather from places like forums or blogs?
It seemed mixed, based on the sources cited. Some historical bullishness, maybe, but more recently kind of neutral from news sources, maybe mildly bullish among some bloggers or commentators. It often reflects that speculative interest we talked about.
What about short interest? Are lots of people betting against the stock?
Apparently not. The report highlighted a very, very low percentage of the float sold short, basically 0%, 0.00%, and it had decreased recently.
So minimal bearish bets from traditional short sellers.
Seems that way. Although you might see daily short volume figures from Finery that look high sometimes. But that's a different metric measuring daily trading activity, not the overall percentage of shares held short. The report clarifies that difference.
Okay. So putting this market picture together, OTC trading, low price, high volatility, no analysts, basically zero short interest. What does that tell you about how the market views RDGL right now?
It screams highly speculative. The characteristics all point to a security whose price is likely driven more by news flow, maybe clinical trial updates, funding announcements, rumors, and general retail sentiment, rather than traditional valuation metrics or broad institutional buying or selling.
Makes sense. Okay, so who actually owns the stock? That ownership structure can sometimes tell a story too.
It can. The report mentions some varying figures for insider holdings, the shares held by management and directors, somewhere between maybe 2.3% and potentially as high as 18.5%, depending on the source or calculation.
So a bit unclear, but probably not huge overall.
Probably not a controlling stake, no. The company's official 10K filing would be the definitive source there. But like we mentioned, the CEO's recent open market purchases are a positive data point within that insider picture.
Right. And what about institutional investment? Big funds, pension funds, mutual funds?
According to the sources the report looked at, negligible, basically zero. Figures like 0.03% were cited. Or simply noting that no significant institutions seem to hold enough shares to require filing disclosure forms.
So if insiders own a relatively small percentage and institutions own basically nothing, that means the vast majority is held by
the public. The public's float is very high, probably around 95% to 98% of the shares outstanding.
What does that kind of ownership structure typically mean? Mostly public, few insiders buying, no institutions.
Well, it's pretty characteristic of many microcap stocks, especially the more speculative ones. It suggests trading is likely dominated by individual retail investors.
And why might the big institutions be staying away?
Probably comes back to everything we've discussed. The high-risk profile, the clinical uncertainty, the regulatory hurdles, that going concern financial risk we talked about, plus maybe the lower liquidity on the OTC markets. Big funds often need more stability, more predictability, larger trading volumes, and just a bigger company scale than Vivos currently offers.
Okay. This sets the stage perfectly for the report's overall risk assessment. It used a SWOT analysis, right? Strengths, weaknesses, opportunities, threats.
It did. A good way to summarize. Let's start with strengths. The report highlights their proprietary technology, radiogel, isopet, and the patents behind them. That's a core strength.
Okay.
Then there's the FDA breakthrough designation for radiogel, which is a positive signal. Experienced key leadership, even with the age factor. The dual market strategy, with isopet potentially providing early traction and data. And some early positive human trial data reported from India.
Okay, those are the positives. What about the weaknesses?
This is where it gets serious. Significant accumulated deficit, ongoing net losses, and that negative gross margin on the current small revenue stream. That's a major weakness.
Yeah, we talked about that.
Heavy reliance on external funding, leading directly to that going concern disclosure. Limited resources compared to potential competitors who are often large pharma or established medtech companies. No significant sustainable revenue yet. And the report specifically calls out Morningstar, giving them an economic moat rating of none.
None for the economic moat. That's pretty blunt, isn't it? What does that really tell you about their competitive position?
It means that, in Morningstar's view, the company currently lacks any durable competitive advantages, things that would protect its profits and market share over the long term. So, despite having proprietary technology, they haven't yet established a strong, defensible position against competitors, either existing ones or potential future ones.
Got it. Any other weaknesses mentioned?
Just reiterating the low analyst coverage and lack of institutional ownership, which limits visibility and validation. And as we discussed, the potential question mark around key management age and succession planning down the line.
Okay. Opportunities. Where's the potential upside, according to the report?
Well, the markets they're targeting are large and growing, as we noted earlier. So the biggest opportunity is clearly potential FDA approval and successful commercialization of radiogel if the trials work out. Huge if. Also, expanding Isopeti's reach in the veterinary market, international growth, particularly leveraging their current focus in India, potential for strategic partnerships with larger companies, and maybe even expanding their PRNT platform technology to other isotopes or cancer types eventually.
Right. And now the threats, the big risks that could completely derail the whole thing.
The report is clear on the major ones. Number 1 and 2 are probably failure of the clinical trials for radiogel and the inability to get FDA approval or facing huge delays or really tough requirements from the FDA. These are existential threats.
Okay. What else?
Intense competition. They're trying to enter fields with large, well-funded, established players. That's a constant threat. Critically, the inability to secure necessary future funding. If the cash runs out before they hit key milestones, that could lead to insolvency or just incredibly painful dilution for existing shareholders.
So funding is a constant threat, too.
Absolutely. Then there are risks, like challenges with market adoption, even if they get approval. Doctors need to be convinced to use it, reimbursement needs to be sorted out, and potential intellectual property challenges, maybe patent disputes or lawsuits down the road.
The report also briefly mentioned a hypothetical risk from U.S. tariffs. Is that a big worry right now?
Probably a secondary risk for Vivos at this specific moment, according to the report. Their revenue is tiny, and the main focus is R&D, which might not heavily rely on tariff-affected goods.
Okay.
However, the report notes it could impact costs for things like clinical trials or the Isopeti business if key supplies get hit by tariffs. And if they ever do reach commercialization and rely on international supply chains affected by tariffs, then it would become much more significant.
But their planned India facility could help mitigate that.
Potentially, yeah. Could be part of a strategy to manage that risk.
So, summing up the risks, which ones are the absolute showstoppers, the biggest hurdles Vivos has to clear based on this report?
It really boils down to those critical interconnected ones. Can the clinical trial succeed? Can they navigate the FDA regulatory pathway? And can they keep funding the whole operation until they potentially reach commercialization?
They seem very binary.
They really are in many ways. Failure in any one of those areas, clinical, regulatory, or financial, could easily cascade and jeopardize the entire company, regardless of how promising the core technology might seem on paper.
And that non-economic moat rating.
Yeah, it just underscores the situation. Despite the innovation, the report suggests they're entering these tough markets with no established, durable competitive advantage today. Their future position is entirely theoretical, completely dependent on successfully executing across all these high-risk areas.
Okay. This deep dive has really laid out the potential, but also the huge challenges Vivos faces, all seen through the lens of this specific report. Let's circle back now to that value investing framework we started with. How does Vivos stack up against those classic tenets, according to the report's analysis?
Right, let's tick through them based on the report's findings. First, is the business understandable?
What?
Conceptually, yeah. Targeted radiation therapy delivered by a gel. You can grasp the idea, but the report makes it clear. The underlying science, the specifics of the Y90 hydrogel, the complex regulatory path, the competitive landscape, it gets very complicated very quickly for a generalist investor to truly understand deeply and evaluate confidently.
So maybe conceptually, yes, but practically complex.
Okay.
Second, favorable long-term prospects.
The target markets are large and growing, no doubt, so the potential is definitely there. But, and this is the huge caveat in the report, realizing that potential is entirely conditional on successfully navigating those massive financial, clinical, and regulatory hurdles we just talked about. The future is highly uncertain, highly speculative.
Okay, third tenet. Rational and honest management.
The report points to some positive signs here. The CEO buying shares on the open market suggests belief and alignment. The transparent disclosure of the going concern issue could be seen as honest, but assessing rational capital allocation in the traditional sense, it's kind of impossible when the company is consistently losing money.
Right.
Rationality here becomes about effectively using very limited funds to try and reach those critical development milestones. And that's constantly being tested by the urgent need to raise more funds.
Makes sense. Okay, finally, the fourth tenet, attractive valuation.
Well, the share price is objectively low, pennies per share. But attractive in value investing means buying something for significantly less than its intrinsic value, getting that margin of safety.
And for Vivos?
For Vivos, the report concludes, calculating a reliable intrinsic value is basically impossible right now. There's no history of earnings or positive cash flow. The book value is negative. And the entire future depends on these highly uncertain binary events like trial success and FDA approval. There's just no apparent margin of safety based on current financials or any kind of predictable future performance.
So, no reliable way to say if it's truly cheap relative to its real worth. Which brings us to the report's bottom line, the conclusion we teased at the start.
Exactly. Based on everything we've covered, the high degree of risk, the fundamentally speculative nature of the investment, the lack of predictable earnings or cash flow, the significant financial fragility, and that extreme difficulty in reliably assessing intrinsic value or finding any margin of safety.
The report's conclusion is?
The report concludes that Vivos Inc., RDGL, is best avoided by traditional value investors, or at the very least, placed firmly in the too hard pile.
Too hard pile.
Okay. It suggests the risk-reward profile aligns much more closely with what you'd expect from venture capital investing, rather than investing in an undervalued, established public company with a discernible value.
Okay, that's a strong conclusion. Why does the report land there, avoid or too hard?
Because the investment case, as presented, isn't really about buying an existing asset that generates predictable cash flows for less than it's worth. It's fundamentally a bet on a future medical innovation succeeding against very long odds in a tough market while needing a lot more money to even get there.
Right.
That level of binary outcome, that speculation on future breakthroughs, it's just fundamentally different from what the principles of traditional value investing are designed to analyze and capitalize on.
So what does that classification, too hard, like venture capital, mean for different types of listeners tuning in?
Well, for someone who strictly follows a traditional value investing approach, the report sends a pretty clear signal. This probably isn't the kind of opportunity you're looking for. Look elsewhere for things that fit your framework. But for an investor with a much higher risk tolerance, maybe someone specifically interested in the potential of early-stage biotech or medtech. It might still be intriguing, but they absolutely need to understand, according to this report, that they're taking on a level of risk much more like investing in a private startup.
Where the outcome is far from guaranteed.
Exactly. Far from guaranteed, potentially binary big success or complete loss, rather than investing in a more mature, established business with a track record.
That distinction is really clear. Wow. This deep dive, based on this report, has certainly illuminated the complexities and the, frankly, enormous hurdles Vivos seems to be facing.
It really has. It paints a picture of a company with genuinely interesting, potentially transformative technology. But the path to actually realizing that potential looks incredibly steep and fraught with risk.
So, maybe here's a final thought for you, the listener, to chew on, building on that venture capital comparison. Does Vivos Inc., as presented in this specific report, represent a genuine potential leap forward in cancer therapy, making it a high-stakes, maybe even necessary bet where success is binary? Or does its current profile that finances the risks, the uncertainties, serve as a clear signal that some opportunities, no matter how promising the tech might seem on the surface, are just too uncertain, too speculative for the public markets and for most traditional investment approaches?
That's really the fundamental question you have to ask when you look at companies at this very early high-risk stage.
Absolutely. All right, that wraps up our deep dive today into Vivos Inc., ticker RDGL, all based on that independent research report sent in by a listener. We really hope this analysis gives you a much clearer picture of the company, its potential, its challenges, and particularly how it looks through that value investing lens.
And remember, really digging in to understand the business, the financials, the management, and especially the risks, it's just paramount, especially when you're looking at potentially speculative opportunities like this one.
Couldn't agree more. Hey, don't forget to like this deep dive and subscribe wherever you're listening. It really helps us out. And if you want us to prioritize a deep dive on a stock you're interested in,
Become a member. Euro 4.99 a month at stockanalyticsai.com. Give us a ticker, we'll get on the analysis.
Yep. And make sure you're subscribed to the Stock Analytics AI YouTube channel, too, for more deep dives coming your way.
Okay, now for the important bit.
Yes, the disclaimer. A quick but vital one. Please remember, this entire discussion was based only on the specific source report provided to us. It reflects the interpretations and findings within that report. It is purely for informational and educational purposes. It does not constitute investment advice in any way, shape, or form.
Investing in microcap stocks like RDGL carries significant risks. These are inherently speculative securities, and you could potentially lose your entire investment, all of your principal. We are simply relaying the report's findings and analysis impartially.
Absolutely. Always, always do your own thorough due diligence, consider your own risk tolerance and financial situation, and maybe consult with a qualified financial advisor before making any investment decisions.
Well said. Thanks for joining us for this deep dive, everyone.
Yeah, thanks for listening. Until next time.